I'm very fortunate to be joined by Nelson Griggs for an in-depth conversation about the state and future of the capital markets. Nelson is Executive Vice President of Corporate Services and President of the Nasdaq Stock Exchange. He oversees new listings and capital markets business, as well as global business development and relationships with 3,500 listed companies around the world. He is also a board member of Nasdaq Private Market and has been at the company since 2001. Now, we only have 25 minutes, and my clock is already ticking, to cover a lot of ground, so I'm going to dive straight in. Nelson, we're seeing the stock market at all-time highs right now, or near all-time highs perhaps today, but that's not translating into IPOs. What's kind of driving the disconnect?
Yeah, so I think we had a handful of years, 16, 17, 18, where IPOs outperformed the broader market by a good 5 to 10% or so. So it was a pretty healthy market, anywhere between 150 IPOs to almost 200. And this year we have a lot of the numbers to back it up. There will be close to 200 IPOs this year or more. But the performance has been very mixed at best, and it's been obviously lower than the averages to a pretty large degree. There are some pockets of strength. I'd say enterprise tech has been doing much better than consumer tech. We have had the deals pricing or raising between 100 million to $1 billion have performed better than some of the mega cap offerings everyone's kind of waiting for. So I think we saw the market really start to deteriorate a little bit in terms of performance in the July timeframe or so. I think we were kind of put a stamp on it about this really a massive shift of what expectations are of profitability for companies, and that's really driving all the conversation now for public companies that have gone out recently, as well as ones that are thinking about going public, is what is that more immediate path to profitability.
Yeah, I was going to say that the expectations about profitability, I mean, that sort of, I guess, explains kind of some of the recent IPO softness that we've seen sort of coming out with Uber, Lyft, Peloton. But what do you think it kind of tells us about investor demand and kind of where valuations are as it relates to that profitability?
Yeah, I think there's investors in this audience knows this very well are looking to where is going to be the best opportunity at any given time, and we see that historically has been IPOs. There's been a nice lift or a pop, and when that kind of goes away, I think the market has a herd mentality and shifts very, very quickly. And we saw that shift go away, and companies that were preparing to go went, wow, we have to kind of think about our story, and got caught up in that quite a bit. So I think you're just looking for that consistency, that stability. We saw utilities start doing better in other sectors. And if you have a really healthy IPO market, it's driven by technology and healthcare. They represent about 70% of IPOs, and they are again this year, but they're just not performing that well. So that makes the next group a lot harder to go out. So I was much busier last fall in pitches than I am at the moment.
Oh, we're grateful for that, as you're now able to join us. But how worrisome would you say valuations are? There's a lot of talk about valuations being stretched in the stock market writ large. But also, some of the IPOs that we've seen come out, there have been real question marks given sort of their performance after listing. Like, is that a concern, do you think, the valuations?
Well, I think the biggest discussion we have is really, if I focus on private companies, is there a disconnect between the private valuations versus the public valuations? That's talked about all in the news. That's not a new topic. But that's really, I spent a lot of my time on the West Coast, been out there twice this month already. And that is coming to try and digest what that means to them. The valuation they think they have, or their employees think they have, what does that mean to their path to an exit? And does that really recalibrate? So we run the Nasdaq private market that does secondaries for private shares. And there's some names that would be well known in the room here that are having a hard time today finding buyers. Right? If I go back a year ago, money was being thrown at these companies for secondary sales. So we are in a moment where valuations are shifting. Investors are getting much more particular about what they buy. They're not just buying everything. So I think that, how long does that last? The same exact thing happened in 2017. We saw that disconnect. It rebounded very quickly. So I think this is anyone's really guess about how long it takes for that to really come to some sort of equilibrium where the private and the public get to the same ideas.
Not to put you on the spot, but what's your guess as to when the equilibrium is reestablished?
It feels like it's going to be a little longer.
Okay.
I think you're looking at a lot of the performance, the bulk of the performance of the IPOs this year, indicate to people who are looking for that valuation lift in the private space. We're seeing a lot of the funds that bought into some of these companies, they're kind of feeling that pain a bit now. So I think the only thing that kind of keeps this going is there's so much money going into venture capital still. 20% year-over-year growth over the last handful of years. And it's not just venture capital, it's the corporate arms of venture. It's a sovereign wealth fund, so you can still raise private capital very, very easily, and that does tend to continue to push that valuation. So I think you're just looking at how what is that ultimate end game, that exit. But we're still creating unicorns, especially internationally, by the day.
And it certainly sort of seems as though the sort of time it takes for these sort of startups to transition into the public market has been getting longer and longer, the time to IPO. I mean, presumably kind of like seeing sort of these valuations, that can only get longer given sort of the performance we've seen kind of those that have tried to go public.
Yeah, I think we'll see how that correlation would play out over time more than what's going to happen in 2020. But clearly, this has been a long-term trend now where companies are staying private much longer. They are trying to get to that scale. I think you're going to see them shift, though, as opposed to just growth and saying, how do I now try to think about that profitability story much more quickly.
So more of an existential question for you. I mean, why is there so much private money still looking at these companies? Like they're coming into the public market, investors there are saying, not for me. But for private money, it's still lining up and wants to be involved in these companies at these valuations.
Well, this room probably knows better than I do. I think you're looking for growth, right? And it still comes private markets. There's been some very good exits this year when you look at some private companies, whether it be they're off their highs, but a Zoom, a Datadog, CrowdStrike. You've had companies do very, very well, but it just, I think, getting a little bit more selective. But I think everyone's trying to say, how do I, find that avenue to growth? Because we know how hard it is to find growth in the public markets.
And does the fact that people are sort of sticking in the private markets rather than going public, does that have any implications, do you think, for how the economy actually works? Does it make our markets less efficient? Does it remain to be seen? Where do you see that?
I think the biggest things people talk about is a lot of folks not getting access to those companies. We can maybe say, is that going to, that could expand over time. We can talk about what we're doing in the private space. But I think the longer they stay private, I don't see quite the issue out there when it comes to liquidity, because if you are a private company, you can get liquidity in a lot of ways today. So there is this ecosystem developing around the private markets that allows companies to do a lot of things they might do in the public space. And we think we're in kind of the second or third inning on that. That's going to continue to grow. So I think long term, you say, are there enough for the buy side? Are there enough quality investments out there, enough quality companies? And if we see that IPO pool deteriorate or shrink over time, does that get concerning? We know a lot of the performance in the S&P and the Nasdaq 100 is driven by the top companies, and how long can that last?
I mean, that's interesting what you say about kind of the sort of the private market being able to do some of the things that the public does as well. I mean, does that kind of have a sort of long-term sort of negative outlook then for public markets more broadly?
We just see more of a blending of private and public, and the things that you can do in the public space today as a company: raise capital, get liquidity, get a brand, do certain things. You can come pretty close to doing a lot of that in the private space. Now you can't get regular liquidity, you can't get the same sort of scale and size in the public space. So at some point, companies do say they want that, and they obviously do like the brand aspect. But we started a private market 5 years ago to help companies with secondary liquidity. And the attitudes of companies, this was post Facebook, were, hey, we really want to control every aspect of this. And that attitude has changed dramatically over the last 5 years, where companies are really letting their employees at certain times get liquidity. They can obviously go ahead and raise money. So again, the attitudes of disclosure of private companies allowing for liquidity is changing very, very rapidly.
Well, I promise we wouldn't get through this conversation without talking about direct listings. So we're going to talk about those now. When people are thinking about, or companies are thinking about direct listing versus an IPO, versus staying in the private market and sort of making sort of venture capital sort of pay for their next area of development, what should they be thinking about as they kind of consider those different routes?
Well, I can't get out of a meeting on the West Coast without talking about direct listings. Every company is saying they want to do a direct listing. I don't know how broadly audiences follow that topic, but really what they're looking at doing, the direct listing allows for you to really have a true auction when you go public. An IPO today, really the auction occurs the night before at pricing. A direct listing allows, one of the main attributes of it is, for a company's perspective, they're not giving up, quote unquote, the pop on day one. there is the ability to reduce fees. You have usually 1 to 3 advisors, and you're paying them probably quite as much as you would if you did an IPO, but you're not paying the whole syndicate. So you're able to reduce their costs. And then there is a lot around the lockup, where there's not going to be a lockup. So for sellers, and a lot of the people who are behind direct listings are the VC community, like the fact that if they want to sell on day one, they can much easier. So there's a big buzz, especially in the Valley, on direct listings.
And do some of those need a reality check?
Well, we'll see. So everyone's talking about it. There's been 2 at scale. Now, direct listings have been around since 2014, so they've been around a while. But we changed some rules, both Nasdaq and New York, to allow for advisors to really be part of that process and to help set that reference price. So it's been the product has matured quite a bit. But I think we're still in the early innings of that. And you've seen pretty well-established companies go. I would say if I had to bet next year, although I'm talking probably got 100 questions in the last 2 months on it, I'd say we see 4 to 6. You're going to have the large names that have the brand name cachet can attract that supply and demand on day one. I think where it really has to get to be more broadly used is, does the $3 billion market cap tech company that no one in the room here has really heard about, or maybe not many, can they go do a direct listing? And we are talking to some that want, at that scale, that want to do this. If they get out and are successful and they get a model there, you will see more and more come. But I think it's going to take a bit of a road to get there, because again, you need to have an awareness of who the company is. It's a lot more work on the company. They don't realize once they get involved in this process how much that education process that the banks do are reliant on them. So there's a lot of buzz around it. I think there's some reasons why companies should definitely consider it. We're pretty agnostic. We have a great process to do that. It's really like an IPO here at Nasdaq. We're talking to all the advisors and the ecosystem around it, working with the SEC on, can you actually raise capital in a direct? So I think we're at the early days of a direct listing, and there's certainly some appeal to it, but maybe not. We're not going to see quite as many as the whole world's going to go start doing direct listings.
That's interesting. So it's still a relatively small part of kind of the overall sort of listings business. But are you guys taking any steps to shift structurally? Obviously, you're getting a ton of questions about it.
Yeah.
Does that mean bringing any new resources, changing how your teams think about things?
Great question. Yeah. So no, I do have a team here that's focused on helping companies think through all the parts of the process. One thing that companies don't realize, again, is how much of the education to the streets on their end that they have to coordinate and do. So I have a whole IR business that's helping to kind of inform companies of that process, how they're going to organize the buy and sell groups, and a lot of the advisors who are involved in it too, the banks. So we call that the banks. When I say advisors, it's the banks. That's their name in this process. So we're all kind of working together to make sure companies, if they do this, they don't go out and have a really bad experience.
And that is pretty much key, because we certainly know, looking at the IPO market, that there have been some negative experiences, and that's got one of the reasons why people are so interested in direct listings.
Yeah.
Right?
Well, I mean, and again, I think back to Google's IPO. If that hadn't had some of the noise around it, that was a Dutch auction. This could be a Dutch auction type process. So there's ways to make this maybe more efficient, and we'll see where it goes.
So whether you're talking about kind of direct listings or IPOs with companies, like, what would you say is kind of like your core proposition as to why they should come with you guys and not some of the other folk?
We just like to talk about it in a life cycle. So we work. One thing that's very unique about the U.S. is we're the only country in the world that has 2 primary exchanges that compete. So I also operate the Nordic markets, and I don't have a competitor there. There's a lot less I do there for companies than I do here in the U.S. So when we came along at Nasdaq, there's a lot of talk. This is the small cap market. Today we sit here with the 5 largest in the world and a pretty diverse group of companies. So we really focus quite a bit on how we think about what a company goes through from startup to Apple, with the support system they need from investor targeting, investor outreach, governance, all sorts of things across life cycle. And I own tools, technology, advisory services that really my competitor doesn't, to help them along that way. So we're getting pretty early. I'm bringing a lot of those tools that I've done for years in the public space down to the private markets. So we do help companies early with liquidity. We help them understand how to target investors, what good governance means. There's a ton of focus on ESG now, so how to prepare for that. So I think I've got a pretty advanced toolkit to help companies really understand the value that Nasdaq brings over time.
It's interesting you mentioned ESG. We hear about that a lot in the ETF space, where I'm obviously kind of spending most of my time. Like, what are companies wanting your help with when it comes to ESG disclosure and what they report and how they should think about that?
To understand what the heck's going on and what the value of it is, really. So you have companies who it sits in the IR team. some it's in the governance side, some they actually have a sustainability team. And they're all thinking through what does ESG, mean. They're all doing things around it, but how they actually, first and foremost, they say, how do I deal with MSCI, Sustainalytics? I'm doing this the right way. They're not giving me credit for it over here. So it's a little bit of some of the proxy advisory firm challenges are now starting to creep into the ESG landscape. So they're thinking about how they deal with the rating agencies, number one, and then how they communicate that story, and then what investors it really matter to. Mm-hmm. So there's different layers, and I have an advisory team. We started about 3 years ago thinking through this because Nasdaq itself is pretty advanced on ESG, where we are on the UN team for sustainability for exchanges. We run the WEF. So we have a whole sustainability effort inside Nasdaq. We kind of take some of those learnings to just sit down, I have a business around this, educate companies on what they should be thinking about and how to maximize it. Knowing that a lot of the noise around ESG investing, some funds just really relabel things, and so what really matters is really the question. But it is a boardroom topic, and that's what makes it kind of compelling for us to really support companies on it.
Interesting. So it's kind of a competitive aspect.
Yeah, and you have some very forward-thinking private companies are saying, should I bring this into my story for the roadshow? Mm-hmm. Should I talk about what we're doing? And there's different trade-offs to that.
Interesting. So I'm curious, there's been a kind of few newcomers in the exchange world recently, Members Exchange, Long-Term Stock Exchange. Like, how do you view sort of their role in the markets, and how do you think about kind of facing up against them?
So there's the trading side, which that's not my direct business, and there's the listing side. And I think most know in this room probably IX was seen as the next listing venue that was going to be created. I think the challenging thing for companies or to create a listing exchange is just it's a scale business. So all those things I mentioned that I do is across 3,000 plus companies for a brand new exchange. And quite frankly, our listing fees are not exorbitant. So having a new company come in like IX, say we want to start a brand new market, provide really very limited services and take a chance with us is not really worth a company to think about doing that. So the one that's interesting today is Long-Term Stock Exchange. If folks had followed with that what they're doing, it's really more of a set of principles now than what companies. It's really trying to marry, and we applaud them for what they're doing, trying to marry the investor side with the company side, and how can that be more of a focus on the long-termism of a company. Now, how that works and how that plays out, we'll see. They have filed with the SEC to be an exchange. They've been approved to do that. The rules they have in place are guidelines, are not requirements. So today, if you would go public, you'd probably want to list on Nasdaq and have a secondary listing with approval process through a long-term stock exchange. We know that team real well. But there's really nothing you couldn't say you're doing if you want to be on Nasdaq that that the long-term stock exchange is really bringing in that stamp. So listing is different than you get to the members exchange. That's on the trading side, and that's I think we've seen that happen from time to time, whether it's BATs, et cetera. There's going to be competition to make sure that companies are getting the best pricing, that the data pricing is where it needs to be, et cetera.
How do you guys think about data as sort of an area where you can be competitive with other exchanges out there? It certainly seems as though kind of like having data and being able to kind of distribute that data is something that more and more sort of venues are doing as alongside their listing and trading.
Yeah, we have a very big data business at Nasdaq. It's about 28% of revenue or so, and so I think that business is changing a lot more to pushing out data to actually sourcing data that is going to give signals and tells based on some advanced technologies to help investors make better decisions. And we've been historically focused just on the sell side, and now we've done some efforts on the buy side with the purchase of the investment. In other areas, we purchased a company called Quandl that looks for advanced algorithms to tell directly where the market's going. So I think data for the investor side is a critical part to who Nasdaq is and what we do. On my business, a real quick example. So we have an IR tool that has 8,000 clients on it, and we're tracking. They have a CRM system in there. So every meeting we're tracking with machine intelligence, say what company is meeting with who. We know buying patterns. So the more I can help a listed company understand where their time is best spent with investors and help investors, know what companies they want to meet with. So we're doing a little more matchmaking on the investor side. And so really just I think everyone is saying with data, how do you get away from just pushing out data to companies, pushing out to investors and giving them more usable data? And that's a big focus of Nasdaq. And then on the trading side, so we run the largest surveillance trading business in the world called Smart. So when there's an exchange or a government that has an issue come from the markets, they're calling Nasdaq. That's obviously ripe for machine intelligence and some more smart technologies to really try to not just report on the bad stuff, but actually predict the bad stuff.
Interesting. Okay, we'll see how that kind of pans out.
Yeah.
Talking of kind of like the future for you guys, I'm curious about the IPO pipeline, specifically for next year. We've obviously got a big year coming up, a lot of political drama that we can inevitably expect. Does that impact the timing of how people should be thinking about IPOs? And do you expect to kind of see a lot of that front-loaded into the first half of a year as a result?
Yeah, in an election year, usually there's anywhere from 10 to 20% fewer IPOs. You kind of lose November and October a bit, which tend to be pretty heavy IPO months for us. So more clearly would be a challenge with the general performance of IPOs, I think, than the election year. But you have all that going on, and I've made predictions where the IPO market will go in the past and have been deadly wrong. So it may have a hot market next year. But we had to guess next year is a bit more of a muted market. We can kind of tell what's coming up. Maybe we have a good 3-month look now because companies have to submit applications. We know they're going the road, and I would just say it feels a little softer to us right now than it did last year. And we really need to see the performance of the companies, pick up. You want to have, for a great IPO market, you want to have a good overall healthy, S&P average, et cetera. You want to have a lower volatility index, but you really have to have the deals that have gone out previously do well for the investors to get excited, and we don't have that right now.
Interesting. And in terms of kind of like where we might see those sort of companies coming from, I mean, you mentioned that tech and healthcare tend to be sort of the leading kind of sectors. But geographically, are we thinking US companies? Are we thinking international companies? And do you think tech and healthcare will still dominate next year?
I still do. Tech and healthcare will dominate. We had a pretty soft PE. Number of PE exits this year were pretty slow, so we're hoping that picks up a little bit. But China is just insanely active right now. And I think the biggest difference with the companies in China, in the US, we're seeing, if I speak with technology, the average technology IPO has been private for at least 10 years, some upwards of 15. In China, it's 2 to 4. So the ability for them to get to scale in China is just it happens much more rapidly. So we're tracking 40 unicorns in China. The valuations just are staggering. Now you could say, okay, is that really a real valuation or not? It all depends when they actually get out and come. But they still do want to come to the U.S. Hong Kong would like to have more of these listings stay there. But I think that is a market that it's hard. I lived in Hong Kong for a while, I guess going back 8 years ago, and a lot of the technologies at that time in China were more the copycats and Me Too's, and now it clearly has moved into more some truly innovative companies, and they're a lot more global. So back then it was all companies really just focused on China, and now they're thinking more globally as well too. So it's hard to underestimate what the impact of that could be, even with all the macro stuff going on.
I was going to say that macro stuff. I mean, have you seen sort of the?
It's important.
Yes, it's been a lot of news, that's for sure. Are you seeing kind of the trade tensions between China and the US, or even the protests in Hong Kong, kind of weighing on any of that interest from Chinese companies?
I think the more challenging concern is governance than necessarily the trade wars. The trade wars has an overhang, but it really is: are the investors going to be comfortable with the governance structures out of China?
Interesting. And then one final question before we have to wrap this up. Just speaking from my own personal perspective, I cover the ETF market and indexing. So I'm very curious as to kind of whether the companies that you talk to about going public think about kind of whether they will be included in an index as one of the reasons why they might think about IPOing or not, and how they actually position themselves to the indexes. They don't care?
No, I would say that when companies are going public, you think about even these large companies, you're like, okay, they're mature and they're larger. They're really kind of just trying to tackle a lot of the basics. Many have not had an IR professional for more than 6 months. Maybe some that have been around a long while or got to very large scale, but have more infrastructure there. I think they think about it, but they don't really understand the ramifications. Now, when they go public, I'll flip to that. Clearly they think about it often. I think they look at it as both an opportunity and a threat. On the opportunity side, they know they need to be in indices because they're very important to their visibility, maybe shareholder share ownership. But they also look at just the power of ETF and indices, and they're with the buy side consolidating. There's a lot of demands to try to get the attention of the buy side, with that the active buy side kind of shrinking a bit. That's their concern, is how they fight for that time with companies. Our IRO is awesome. He gets ranked near the top. He's like, this is a sales job. I'm out there proactively all the time trying to get the Nasdaq name, and we actually have a pretty good brand, or well known, and he still has a hard time sometimes getting meetings. So you take a smaller company, and they're thinking about just the power of indices, ETFs, passive. That's probably where the concern side comes in, but they all want to be a part of it, if that makes sense.
It does. Interesting. Well, I'm afraid that's all we've got time for. Thank you so much for taking the time, and please join me in a round of applause.
Thanks. Thank you.